Today's investing is so different than it was during our grandparents' time. Back then, there was no such thing as a meme stock, nor were there computers trading with one another via automated trading bots. But with the rise of sophisticated software and social media, well, things just aren't quite the same anymore. For beginner investors, this new stock market can be a little tricky to navigate, so I created this video to share with you some practical advice that will give you a fundamental base on how to get started investing in stocks. Now, you won't become an expert after watching this video, but hopefully it'll help you avoid some very costly beginner mistakes. These 5 tips come from my personal experience investing in the stock market. They are things I wish I knew when I first got started, and now that I do know them, it's helped me make much better investment decisions and obtain greater long-term gains. So let's dive right into it after you hit that like button, of course. All right, thanks guys, let's go. Tip number 1 is to get your emotions in check. The stock market can be a fun place to be in when the market is doing well and stocks are going up. It can even become a little addictive to want to check in on your stocks from day to day. I mean, why not, right? That adrenaline rush from seeing your money grow is exciting. Actually, when stocks are going up, most beginner investors get caught up in the excitement of it all, and unfortunately, that excitement can cause you to overestimate your chances of success. Casinos, for instance, know this all too well. That's why when you walk into a casino, you generally will see big bright lights and hear loud noises coming from tables and gaming machines. Casinos know that the more excited you feel, the more likely you'll be to spend large amounts of money and underestimate your risk. Similarly, in the stock market, some investors are willing to take riskier bets and go all in for the thrill of the bigger win. And just like casinos, one popular trading app among millennials and the Gen Z investors, Robinhood, wanted to cash in on this excitement by adding confetti and other fun gaming features to their investment app. Well, it worked. Roughly 46% of millennials and Gen Zs are trading more frequently, about double the average rate, and a whopping 51% say their risk tolerance has increased. That's a little bit dangerous because when stocks go down, these same investors are willing to sell at huge losses in fear of losing even more money. But more seasoned stock market investors actually welcome stock market dips. This means they can buy more of the same stock at a discounted rate and take advantage of fear-based selling in the marketplace. Needless to say, keep your emotions in check and you'll fare much better with your investments. Oh, and the Robinhood app, yeah, they scrapped their confetti animation feature on the app after much pressure from widespread criticism of the gamification of trading. Tip number 2, pick companies, not stocks. It's easy to forget that behind every stock ticker is an actual business. And when you buy a stock, you actually own a piece of that company. But once you start poking your nose around the stock forums and chat rooms, you're bound to come across people picking stocks based solely on technical analysis. Basically, a bunch of lines on a graph coupled with trading volume and patterns that should ideally predict a stock's next movement. Well, in a perfect world that has no outside forces influencing it, such as a worldwide health crisis, inflation, trading bots, social media influencers, etc., then maybe these graphs can work and make you a millionaire. But the reality is that most people will lose money and lots of it by basing their decision solely on the technical analysis of a stock. Now, by the way, I'm not against using technical analysis to aid in picking stocks, not at all. I actually think it's a good thing to learn a little bit of it so you can have a good idea of when to purchase into a new stock after you've fully vetted it. At the end of the day, when you buy into a bad company with terrible fundamentals because the technical analysis is showing a good momentary setup, you are risking losing your money on that investment because it may never bounce back up to where you originally purchased it at. So remember, invest in companies, not stocks. Tip number 3 is to use dollar cost averaging to buy into stocks. So let's say you're sitting on $10,000 in cash and you're ready to jump into the stock market and start investing. Should you dump all your money into the stock market now or spread your investment purchases over a period of time? Since neither you nor I will ever be able to consistently predict with complete accuracy where the stock market is headed, a good rule of thumb to follow is to use dollar cost averaging to buy into stocks. What this does is it will allow you to spread out your stock purchases so that you're not buying a stock at high prices, but instead you're averaging your cost per share over a period of time. So if you're interested in the Apple stock, then your investment purchases could look something like this. You purchase 10 shares in January, another 10 shares in March, and another 10 shares in July. The average of these shares will help you take advantage of the market fluctuations and put a lot less pressure on you with timing the market and potentially missing the boat on buying at the lowest possible price. I do this with nearly all the stocks I purchase, and it definitely helps me sleep well at night. Tip number 4 is to invest tax efficiently. I know taxes may be the last thing on your mind when it comes to making money in the stock market, but this one oversight can cost you tens of thousands of dollars or more in unnecessary tax cost over the long run. And I don't know about you, but I personally don't like giving more of my money away to the government, especially when it can be easily avoided. For example, if you invest your money using tax advantage savings accounts, such as a Roth IRA, or traditional IRA account, 401k accounts, 457 plans, and so on, you'll be able to tap into tax benefits such as a tax deferral or tax exemption. These tax-related benefits add up over time and can be the difference between you having $500,000 at retirement versus $800,000. But let's say you're not paying attention to taxes when it comes to investing in stocks. Instead, you open up your Robinhood app, you buy into a stock, and 6 months later, you decide to sell that same stock. Well, you may want to set aside some money to pay a capital gains tax on that investment. If you don't know what that is, then you may want to wait before you invest in the stock market until you have at least a better understanding of how to keep more of the money you make instead of handing it over to the government in the form of unnecessary taxes. This is one huge mistake I see many beginner investors make, and it's really unfortunate that it happens. I made the same mistake when I first started, so I'm right there with you, but do yourself a favor and make sure to invest tax efficiently. Tip number 5 is to read more. This one is a simple yet powerful tip. It's well documented that billionaire investor Warren Buffett spends an estimated 80% of his day reading. That's a lot. You would think that maybe for the small fortune that he's made over the course of decades, that he does a little more than, well, just sit around and read. But that's not the case. Warren Buffett's formula to success is to get smarter. In fact, when asked how to get smarter, Buffett once held up a stack of papers and said, "Read 500 pages like this every single week. That's how knowledge builds up, like compound interest." His method has obviously worked very well for him. I mean, it makes sense when you think about it. The more you know, the easier it will be to spot winning stocks in the marketplace. Now, Buffett's not talking about just reading anything. What Buffett is referring to is reading up on sectors you plan to invest in, as well as reading up about the overall world economy. So, for example, if you're thinking about investing in video gaming stocks, then spending time understanding the sector and where the industry is going will help you make better decisions as to which gaming stock will be the best to invest in right now. It's a simple tip, yet the one I believe will help you make the most amount of money when it comes to investing in the stock market as a beginner. I hope these tips serve you well on your investing journey, and definitely feel free to subscribe to my channel and stick around for more investment videos just like this. Thanks for watching, and I'll see you again in the next one. Take care. Bye-bye.